long-term value for investors. Today, he will be sharing his view on the current equity market scenario, the evolving opportunities, and also take us through the much-awaited launch of MK Emerging Star Fund AIF Series 7, a differentiated strategy designed to capture India's next phase of wealth creation by combining listed market exposure with selective pre-IPO opportunities. This new AIF series will allow investors to have an access to high-quality business before they list. Thank you all for joining us. And without taking much time, I would like to warmly welcome Mr. Manish Sonthalia to take over and share his perspective. Manish sir, over to you, please.
Yeah, thank you, Nitin. Thank you, participants. Thanks for sparing your time this Monday morning during market hours. It's real pleasure to welcome you all on this special webinar that we are having for the launch of a new product, which is AIF 7. And this is a continuation of the AIF Series 6, which is India's golden decade of growth, closed-ended scheme. In the previous series, we actually had only the listed opportunity set. Out here, we are actually working with 70% listed and 30% unlisted. And 30% unlisted would basically be looking at the pre-IPO opportunity. That is to say that we are not going to invest in early stage investing or middle stage investing. It is between, let's say, 6 months to 2 years that IPO window should be visible to us, and therein we'll deploy this 30% capital. And I think this is a unique blend because previously also we actually launched in my previous avatar, we launched a blended product in the AIF, both listed and unlisted, and it did really well because bulk of the capital today, whenever company comes out with an IPO, is residing when the company is actually unlisted, and so this presents a golden opportunity for us to capitalize the best of both the worlds. So in that backdrop, we actually formulated and filed this product, and now that we have got approval, we are ready to launch it. Just give me a moment. I will just put in a small PPT. It's a continuation of the previous series that we had and an added bit on the IPO opportunity that we have. I hope you can see the screen. Is the screen visible?
Manish, visible.
Okay. Sure. So, investment philosophy and framework. Basically, we are long-term investors, a single style of investing. That is to say, pick up good stocks as early in the cycle as possible. Ideally, companies suited to achieve a doubling of profits every 3 to 4 years. The company should have a long terminal value. They should be governed by good managers. I think we are basically having a buy and hold style of investing with a low churn. I think the focus areas for us is basically long-term wealth creation through compounding. That is basically what we cater to. Number of stocks that we'll have in the portfolio will be within 30 stocks. We don't think that beyond 30 stocks there is a need for diversification. We'll buy structural themes in the growth context of India, and we want to achieve this growth through operating leverage as opposed to financial leverage. This is a unique framework peculiar to Emkay, which we call the equal framework, which is to quantify corporate governance and management quality, because management quality is of paramount importance and it's a subjective concept. We have tried to make that subjective concept an objective concept. And in that backdrop, this is one unique framework that is unique to us that we have actually followed over the last 12-13 years that we have been managing public money. What are the attributes? Basically, we classify management quality based on five attributes. Management integrity 40%, capability 30%, wealth distribution 15%, investor communication 7.5%, and liquidity 7.5%. We give marks to each of the companies that are evaluating based on these sort of weightages. After that, management integrity, which has 40% weightage, is further classified and broken down into subcomponents. Management integrity has to do with promoter holding, increase or decrease in the promoter holding, equity history, that is what is the capital raised, bonus issues, etc. that have been given out. What is the proposed FCCB dilution? Promoter pledging, 7.5% weightage given to that. Promoter group salary, auditors remuneration, related party transaction, and royalty. This is a composite view of the 40% management integrity. A lot can be understood about the management in each of these attributes, and when we try to rank them, you know, we have found out that some of the serious red flags in companies are when the promoter holding is more than 70%, there's debt restructuring more than once in the life of a company, there's no investor communication, there's debt is to equity more than 2.5, and in the last 1 year, a large acquisition, more than 50% of the net worth has been taken up, and there has been misallocation of capital in terms of investment in non-related areas. Based on this, we actually give marks to companies, and below 50% weightage or marks that a company gets, we actually don't invest. And based on 85%, 70 to 85%, or 50 to 70%, the allocation actually differs. So objectively, management quality is quantified. And apart from that, when we marry this with the growth, broadly, we are taking care in terms of how the stock will perform over the medium to long term. India's growth is basically a continuation of the journey which started ever since the Lehman crisis broke out. If you look at the right side of the circle, it's basically aggressive bad loans gave way to demonetization, RERA, IBC, and GST. These were the four major reforms taken up by the country. Then we were hit with COVID and the ILFS crisis, which actually promulgated the government to pump in a lot of money into the system, which began a demand recovery in the system. There was a corporate tax cut, then PLI incentives, corporate balance sheets became very deleveraged, and resilient India, in spite of many challenges, have maintained a growth rate of 6.5%. Credit growth rates in the system is hovering double digits, and corporate capex, they are green shoots that are rising. And because more companies are coming into the listed space, corporate profitability, which had sunk to market corporate profits to GDP, which has sunk to less than 2%, is now hovering closer to 4.5%, 5%. So this is a vicious cycle giving way to a virtuous cycle, and we are in the middle of a virtuous cycle as of now for at least the next decade, 2 decades. In the AIF6, we had coined the term India's golden decade of growth, and within that, 5 themes which we think are quite relevant from a growth perspective for India over the next 10-15 years. First is consumption. This is basically a play on the increase in per capita income, and more so on account of discretionary spend that India is going to benefit. Second is digitization and AI. We are in the midst of it. Huge capex is happening in the AI side of things. India is a late entrant into the AI domain per se in terms of capex, etc. There are developed countries which are far ahead. But as like in any innovation of a new technology, India adapts and wraps itself up around the new technology in terms of applications. We think this is also going to be the case in the case of AI. As far as the AI spend, whether that's going to be stay relevant or not, basically $1.5 trillion worth of spend is happening in AI globally. What is going to make sense is that if you are to achieve a 10% ROI, you require revenue of around $650 billion. Annualized IT spends globally, and a movement of some of the spends from SaaS, which is software as a service, to the AI platform would actually mean that a 10% ROI is going to stay. So in spite of many excesses in the AI platform and AI spending, we think that it's likely to stay. AI is here to stay. Some of the companies will fall apart, but this is going to be a big driver of growth in the next 5 to 10 years. The third pillar of growth is energy transition. India is moving away from fossil fuels and has set itself a very aggressive target of 500 gigawatts by the year 2030 in terms of renewables and the entire ecosystem around it. And we are in the middle of it. We already have achieved some milestones in terms of solar capacity. We are looking at nuclear also in a bigger way now, starting early 26. Nuclear is also going to come into the forte of renewables, which is going to lessen our dependency on fossil fuels per se. The fourth major theme is financialization of savings. Ever since we have seen that deposits, debt, by the way, has become, or savings deposit and bank deposits have become taxable in the hands of depositors. And because inflation is very low, your interest rates are not even going to suffice to meet your living standards if you were to continue with this post-tax rate of interest in your term deposits. From that point of view, I think financialization and the equity tilt, which began its journey during the COVID time, is here to stay and grow. And 21 crore demat accounts, 5 crore only broking accounts, both on NSE and BSE put together. AMCs actually having an equity corpus of 50 lakh crores and growing. AIF category 3 and PMS assets in excess of 7 lakh crores, total PMS AIF assets in excess of 40 lakh crores. These are all pointing towards financialization. And even now, the equity penetration is just about minuscule, nowhere compared to where the developed markets are. And again, this is one major important trend that's going to be the leading growth parameter going into the next 10-15 years. And the fifth parameter is actually the manufacturing prowess, thanks to government's incentives and newer areas of focus. Currently, the focus is on renewables, it is on electronic manufacturing, semiconductors. These are some high growth sectors apart from the usual specialty chemicals, pharma, automobile components, where India actually has proven its right to win. So from what we have seen is basically consumption. India is in the cusp of a up curve as far as the per capita income is concerned, and this is going to continue for many years to come. It's just a journey currently, and this pie is only going to get bigger. Some of the stocks which have done well in the previous AIF Series 6 in this space is Allied Blenders and Distillers, is basically catering to the increased alcohol consumption by youngsters in the country. They own the Officer's Choice brand, third largest whiskey selling brand in the world. And, it's a case of a margin expansion, volume growth, high single digits, plus realization growth and premiumization, leading to around 18% sort of increase in margins from 12%, has led to a very increased growth in the company's EPS, and its still journey is still continuing. If we look about the other name that well for us is Godfrey Phillips. It's taking some market share away from ITC, which is a dominant player in the tobacco industry, and Marlboro, the flagship brand, is only increasing penetration in the eastern part of the country. I think valuations are at some discount to ITC. If you were to normalize the earnings for the next 5 years, it has done well for us. We continue to hold this. If we look at the digitization theme, we have many technology companies. We have HCL Tech, we have LTTS, we have LTI Mindtree. These companies are adapting to the AI environment currently. HCL Tech was the first company to report specific AI revenues of $100 million. And I think this journey is only going to grow. Look, the traditional IT spends, apart from the legacy infrastructure, IT infrastructure business, which is in a decline mode. Overall, the IT spends, both from third-party outsourcing as well as your GCCs, that number is actually not going to see a major decline. But GCCs would be growing at 12%. Indian IT is traditionally designed to grow currently in the current environment at around 6-7%. And with AI adoption, I think efficiency gains plus billing increase over a period of time as part of the course, valuations are extremely palatable. If you look at the financialization theme, we have a few companies out there. The recent entrant in this was Grow. We think that these intermediation businesses, are very fine businesses. Intermediation as a business is a very high quality business because you don't require too much of capital. In the case of Grow, which we bought very recently on the first day of the listing of the IPO at 112 rupees, we believe that this is one of the youngest companies in the online platform. founded only in 2020, and they have a market share of 26%, which means that out of 5 crore customers trading on active customers trading on BSE and NSE, these guys have 1.25 crore customers currently. And on that, in that backdrop, because they are ex Flipkart entrepreneurs, their understanding of technology, the UI UX interface which they have got is very, very user friendly, and that has seen an accelerated growth in profits over the last 3 years for them. Even the current run rate of profits and the fact that they are very underpenetrated in adjacencies like your wealth management, distribution, these are not yet tapped at all. We think this company will grow at around 50% in profits. So 2,000 crores of profit is my assumption for FY26, going up to 3,000 crores next year and 4,000 crores the year after that. Why this is going to grow at a superior rate than phygital models or brick and mortar models in the broking platform is because they are leveraging massively on technology. And I think on a total balance sheet size of 4,500 crores, they'll be on course to deliver a 2,000 crores of profit. That should give them around a 45% sort of a ROE. And bulk of the profits which they are going to have, they're going to compound their earnings by moving into margin trading. So this is one of the latest examples that we bought. Then we have names like Nippon Asset, where this is the fifth largest AMC in the country. Again, 50 lakh crores worth of equity AUMs. They are pioneers in the ETF platform. So they are straddling very well between the ETF and the active management platform on the equity side. Even if TERs, which is total expense ratios, are going to come down. Currently, the TERs stand at 1.7. We assume a decline in the TERs going into the next 3 to 4 years. But I think equity AUMs are only going to move up, coupled with market appreciation and huge operating leverage, because AMCs, the major cost item is only your people cost. Bulk of it is basically your not very significant, and bulk of the gains in top line is actually flows down into PAT, out of which this company pays 95% as dividends, owned 72% by Japanese. I think high quality business for the next 10 to 15 years. Then we are looking at some of the insurance platforms like Star Health, 31% market share. It's a number one standalone health insurance. I know there's a lot of controversy around this name, but suffice it to say, what is not good for customers, in a way, is good for shareholders. So if the companies were to be doing everything right for the customers and they don't care about profitability, then you would be comparing this company to the likes of National Insurance and Oriental Insurance, which are public health insurance companies bleeding very badly. But I think this is a year when there is an inflection point in terms of pivoting of profits, moving away from hospitals to some extent, moving to health insurance. Combined ratio for them, because currently they are not making any underwriting profits, they're only having investment gains. I think this underwriting profits, coupled with increase in premium rates, will actually lead to 25-30% sort of a growth for Star Health, and the valuations are roughly around half of what the listing price was. And even at that point in time, the story was intact. It just fell around during the midway due to the COVID in between, where underwriting actually went for a toss. Estimation of the losses due to COVID was not properly evaluated, and so the premium rates actually didn't move up. But I think all of that is now in the base, and this company is on a firm growth trajectory. In terms of manufacturing, pharma is one area where we are betting heavily on this space, apart from auto comps. And out here, bulk drugs, where China has the forte, and in terms of formulations, India has the forte. Apart from that, the CDMO opportunity, even if we were to double the minuscule $3 billion worth of CDMO that we do for in our country, move it to $6-7 billion, it's going to be a massive game changer. Apart from that, the EMS, where if valuations become palatable, looks very, very good. And power capex, etc., if the valuations were to come down, looks very good. Some of the companies which we actually have is Innova and Akums. These are domestic CDMO players. In the overseas CDMO players list, we have Laurus Labs, we have Piramal, we have Cohance. These are some of the names that we have in the CDMO space going into the new series portfolio. Yeah. Energy transition, not so bullish about this because there's overbunching of supplies, but selective names like Tata Power is what we have. The theme is very good, but again, valuations are, so if valuations come down, we'll have many more names. Currently, we are not having any direct wind player or solar equipment player or energy transmission players. I think we stick to our valuation comfort zone of 3 price earnings growth. Many of the names don't fit in. So we have just currently one name, which is Tata Power, which is a blend on both your thermal as well as your renewable story. I think they already have 6 gigawatts of renewable capacity, solar and modules put together. They are going even more backward integrating in putting up a 10 gigawatts wafer capacity. And I think their growth rates are going to be very good and a blend of both the thermal and this. And by the way, Section 11A resolution on the thermal side would give them enough firepower even on the thermal side, the Mundra Ultra Mega Power Project which we have. So this is the name which we are most comfortable with in the energy transition space currently. Other names we find it very, very expensive. Now coming to the pre-IPO opportunity, no brainer. If you look at the right side of the graph, the small and the mid cap segments have given you the best returns on a rolling 5-year basis. I think this story continues, and to tap this story, we actually buying into pre-IPO name because a lot of value remains untapped when you buy it in the unlisted space, and when it gets listed, that creates the best opportunity for us. So we think that there are more companies that is going to go public. Exit valuation generally is better if you do your due diligence properly in terms of the stock pickings in the unlisted space, and there's a larger investable pipeline under research segment of the market. India was the one. India has already seen 297 IPOs YTD, and global IPO volumes peaked in 2021, and we are going very strong. So India remains a bright spot in the global IPO markets, fourth consecutive year of contraction globally. India is ranked globally number one in the number of IPOs Q2 FY25, reinforces India's status as the world's leading IPO hub. Of course, there is a degree of caution to be exercised because everything and anything gets subscribed, so due diligence is of paramount importance. And India's global share of IPOs surged from 5.8% in 2019 to 32.5%. 297 IPOs have already come through. So I think even the next 12 months, the IPO pipeline looks very good. We endeavor to buy a few of them in our portfolio allocation to the extent of 25 to 30%. That should be an icing on the cake for the entire portfolio as a whole. We are looking at late stage investing, that is 0.5 to 2 years. No pre-seed with venture capital, no seed one, seed or series A to C, where we are actually taking low to moderate risk at the time of our exit. So these are some of the cases where IPOs have done very well. Office, Ixigo, Nazara, Nykaa, Policybazaar, Zaggle. These are some of the IPOs which have done well in the past. Some which have not done well: Cartrade, FirstCry, Ola, Paytm, Swiggy, Traction. So a mixed bag in terms of success and failures. Opportunity exists when early access becomes the alpha creation delta, and but it's not automatic. Not every IPO turns into gold. Risk return differentiation is what we are having an experience in. The gap between hype and reality is very, very wide, and we don't want to rely too much on the hype and rest our case in terms of fundamentals when we decide to buy an unlisted or not buy an unlisted stock. What are the filter checklists that we are going to run? The profitability path, margin expansion, capital efficiency, a business model which is going to stay intact at least for the next 5, 7, 10 years, not get disrupted. Management quality is uncompromisable. Corporate governance, these standards have to be maintained, and the proceeds of the IPO would be used meaningfully. What are the warning signs that we have? Narrative driven hype cycles, high cash burn, deep cyclical or trend dependent businesses, governance standards are poor, and overvaluation. This is a snapshot of our series. It's a closed-ended fund where we have ticket size of 1 crore as the commitment minimum amount, which is payable in 5 tranches of 20% over a period of 1 year. Redemption frequency is quarterly, and subscription frequency is fortnightly. There's going to be an exit load of 3% within 24 months, 2% thereafter, and management fee as per the PPM documents. This was about the IPO and the details in our AIF Series 7. As far as the markets are concerned, I think next 12 months you should be closer to 30,000. And this is predicated on the fact that earnings growth is going to accelerate in FY27 over FY26, something like 14-15% as opposed to 10% for full of 2026. So that delta multiplied with lower interest rates in the system should broadly support a 15% growth from where we are, 15 to 20%, and that should be closer to around 30,000 on the index if you take 25,000 as the base currently. And I think rate sensitives are the areas which are going to be in the limelight because of, and these are primary domestic cyclicals which are going to have a good uplift because of lower interest rates in the system. So banks, insurance, capital market, you have NBFCs, real estate, automobiles. These are the 5 major interest rate sensitive. They should be in the limelight. And I think consumption broadly is likely to do much better than what we have seen in the previous 2 to 3 years. Discretionary consumption, and within discretionary consumption, premium consumption as opposed to mass consumption will be basically doing much better. And in terms of defensives, IT remains the best defensive and anti-AI play as far as India is concerned. Resting when if the AI story blows up globally, you will have a silver lining in terms of traditional IT. So IT and valuations have corrected, should be in a sweet spot. Pharma will be in pick and choose. I think rupee is one of the major concern areas, 89 to 90 rupees. $42 billion worth of merchandise deficit previous month was more on account of the fact that you had a massive gold import and fertilizer import. We are running a merchandise deficit in excess of 10 to 11% of our GDP. Nonetheless, our current account deficit currently is very, very stable. And I think with periodic RBI intervention, we should be closer at around these levels only for the time being. And if there are further rate cuts in the system on a global basis, based on AI or no AI, India will present itself a case in terms of FII flows. Domestic flows are pretty decent. I think only risk worry is basically individual companies' valuations and liquidity tightness in the system currently. There is system liquidity which is in deficit, and from that point of view, liquidity has to become better, and the movement of money or liquidity away from secondary markets to primary markets on account of the plethora of IPOs, QIPs, private equities, promoter selling. This has to not be over bunched up together and get dispersed over a longish period. And the proof of that pudding is that when many companies start to get listed at a discount, and this we're already seeing in the SME space, the heightened activity that we saw in the listed space in the last 6 months, that has definitely slowed down because most of the companies that are getting listed at a discount. Similar thing if we have in the main board IPOs, then you will see some semblance of sanity that is coming through in terms of IPOs. Nonetheless, but IPO pipeline remains healthy. Not all IPOs are bad. You have to pick and choose. So that's basically what we are looking at. in terms of the market outlook. Today, there's a lot of index management, even though markets have crossed previous highs. Just about 10, 12 stocks are doing all the heavy lifting. Bulk of the market, or let's say the small cap index and the mid cap index, is still some distance away from the previous highs. A lot of deep pain in the broader market. 25, 30 odd percent have fallen. If you look at the valuation, it's pretty much in line with the last 5 years, etc. Valuation, median valuations. I think maximum 5 to 10% on the downside in the broader markets is the maximum pain that you should anticipate. And even if that gets done, or broadly, we are very close to the worst case scenario when it comes to, that's my understanding, in the mid and small cap space. Nonetheless, you have to keep a tab on individual companies' valuations, deep homework in terms of how the earnings growth for each of the companies are coming through. And within that framework of price earnings growth, if we are having it at less than 3, provided the growth rate suffices, we should be good. It's only a matter of time when this actually gets course corrected, what the deep correction that you've seen in the broader market. I think the crux is to stay put, don't lose or throw in the towel, and in fact have the courage to buy more if there is a further correction in the markets, particularly the broader markets. That's how I look at things, and yeah, I think I have covered everything which I had to. Broadly, I'll just take a pause and maybe open the floor for questions.
Uh, Thank you so much, Manish, for those insightful perspective. Now we are going to move to the Q&A segment. I request all the participants to please use Q&A tab to submit your questions. We have already received few questions. Manish, I'll put it to you. So the first question is from Mr. Yogesh Kumar. He wants to know AI isn't the play in India. Building data center isn't AI play. Can you please throw some light on some companies who will be at risk or reward from AI play?
This data center thing is very overblown, huh? Overblown. This AI infrastructure is quite overblown. AI and AI infrastructure creation, the guys who are helping the creation of infrastructure, like your generator sets and your engines that go into generator sets, all these guys are actually going to benefit. Or the real estate guys, the office leasing space guys, there's office and all. These are basically now looking at GCCs and data centers as the chief growth areas. So residential, or let's say real estate plays required for creation of data centers, or let's say these generator sets, because there's no latency that is allowed when it comes to creation of data centers, etc. But is this basically actually AI? No, this is all about co-location. Compute power is basically residing in the hands of the company who has the computers or the chips. These data centers are basically co-location plays, which are low profitable businesses. Unless and until you have the compute power in your hands, it's basically a leasing business. So not too many, direct AI beneficiaries, but ancillary beneficiaries like your Cummins or TD Power. These are the guys which are basically making the engines, or Kirloskar Oil. These are some of the guys which are actually making the engines for generators. So generator demand has gone through the roof. And all the power cables, etc., because a lot of connecting cables. But these are only ancillary to the creation of data center. India is not a real AI play. They have been late entrants, and still some time to really have some tech companies which are actually leveraging AI in a bigger way to determine profit.
Sure, Manish. Manish, now we have a question from Mr. Ramanathan from Chennai. He wants to know what is your view on the quality and depth of opportunities in the unlisted market today, and also he wants to understand how much exposure we are going to take into this new AIF7 into this pre-IPO space.
So we are mandated to cap this limit to 30% of the total proceeds. Let's say if we have, let's say, 100 crores in the AIF7 AIF, we will at max deploy 30 crores. That is the outer limit. So any number between 20 and 30% is what you should believe should be deployed in the unlisted space. And suffice it to say, if we have, let's say, 30 names in the portfolio, 3 to 4 names will be there from the unlisted space.
And also he wants to have an understanding of the quality and
Quality.
depth of, yes,
It's a
opportunity.
mixed bag. I think this unlisted space will require a lot of experience, a lot of depth in understanding businesses, because it's very easy to get swayed away given what management guides. And management guidance is the last thing that you should have on analysis when you talk to unlisted guys. A lot of groundwork required. I think quality is mixed. You could say the SME space, you have around 60% which are bad, 40% which are decent, and within the 40% which are decent on quality, you have a filter on valuation because the valuations are not palatable. So all in all, SME space, maybe 20% out of 100 is good. The balance 80% are avoidable. And in the main board IPOs, I think bulk of the IPOs would not get any red flags in terms of quality, bulk. Like around 60%, 70% should be good on quality. But the main question out there is valuation.
Manish, we have a question from Mr. Ramandeep Singh from Chandigarh. He wants to understand how much of an influence do you see global macro factors, especially US interest rate and geopolitical tension, have on Indian markets in the near term?
So geopolitical tension is an ongoing red flag. You don't know. I mean, it's like a black swan. So I have no clue about whether tomorrow there is going to be an India-Pakistan war or an India-China war, or whether US is going to occupy, or let's say China is going to occupy Taiwan. I have no clue, but it remains a serious, risk factor which has to be kept in mind. The other big risk factor is the AI. There's a lot of commentary around the AI overspending that is happening. And I think if you were to have a blue sky thinking as to whether we are out of the AI troubles or not out of the AI troubles, how will you decide that? I think OpenAI $1 trillion IPO, if that was to sail through, they are planning for a $1 trillion IPO. If that OpenAI $1 trillion IPO sails through, you can jolly well assume that there is not going to be any crisis from the AI spend point of view, the $1.5 trillion spend point of view. But if the IPO bombs and is not successful, you can look at a serious shakeout. So I think today the growth in the US is propelled by the data, the AI spends. If this AI spend was to get deleted, then US broadly is going to be under recession, and there is going to be some influence of the slowdown on overall global macros per se. No country is going to get spared, but India would be relatively better off because India is standing resilient in spite of the 50% tariffs that have been imposed, and India is an anti-AI play. And if the whole world sinks, then broadly India will be the area where guys are actually going to deploy capital. So yes, all the risks are on the table. There's nothing risk-free in this world. But interconnectivity or coupling or decoupling, we are slightly more decoupled currently than maybe in the last 5 years. Because today the whole environment is about bilateral and not about globalization.
So my question was, with the 70/30 distribution between listed and unlisted, so if let's say the unlisted space, there aren't enough opportunities, so will you be allocating the remaining capital towards the listed opportunities for the time being,
Yes.
and balance it in a flexible way?
Yes, yes. So, opportunities in the unlisted space comes far and few in between. So what do we do in the interim is that portion, let's say you could see 89, 90% allocation to a listed space, and when an unlisted opportunity comes through, there will be some selling that will happen in the listed space, and a portion of that proceeds is going to get deployed to the unlisted name. So it's not that we are going to hold cash 30%. No, that's not going to happen. We are going to deploy it, and as and when the opportunity comes, because this is a closed-ended fund. Over the life of the fund, this 30/70 is going to get fructified.
Manish, we have a question from Mr. Jayesh. He wants to know what's your take on defense sector and also rare earth metals sector as per new
कुछ
norms
नहीं है.
announced.
इंडिया में कुछ नहीं है रेयर अर्थ, कुछ नहीं है, सब कहानी है. So, a lot of things are happening in the rare earth space, a lot of commentaries. I think there's only one company which is doing something out there, which is GMDC. Whole lot of other companies are talking about a whole lot of things. I was in manganese moil mines just 3 days back in Nagpur, and also Hindustan Copper. These guys are also talking about exploring rare earths. But kuch nahi hai. Next 10 years, nothing will happen. But there's only one company which has some lead in doing something for the rare earth space is GMDC. And as far as what was your other question?
No, defense.
Defense is overhyped. Please understand the valuations are very, very avoidable to say the least. India is far behind. We are so dependent on engines in our air force on global things. So can't justify the valuations. So yes, the story is good, but valuations are very rich. Maybe one
We
or two new names, maybe a Bharat Electronics looks like palatable over the next 5 years, even at current prices, but otherwise everything is expensive.
we have a question from Mr. Mukesh. He wants to know, since this is an AIF with unlisted, what might be tax percentage total net return? What can investor expect the net tax return from this series?
Next, tax-free returns.
Yes.
So I think we are endeavoring at least 15-17% from the listed. You should add another 3%, so maybe around 20%.
We have a question from Mr. Rajendra Deora. Sir, what will be the maximum amount will be invested in each IPO?
Each IPO, see, maximum amount allocatable to an individual stock is 10%. तो अगर कोई बहुत ज्यादा ही अच्छा लग गया तो 10% ही डाल देंगे एक कंपनी में, ये तो जनरली 5% डालेंगे. सो anywhere between 4 and 5 names is what you should anticipate.
Now there are 2, 3 people who, Mr. Akshat, Shweta, Rajpuri, they want to understand. They are having a concern with reference to small and mid cap valuation. They want to understand your view.
See, I'm telling you, this is again this valuation. See, what has happened is that last 5 years there has been oversized returns that have come through in the mid and small caps. So the long-term theory says that every asset class should, in India's case, should deliver equal return. So if you look at from long-term point of view, last 10 years, if you look at the returns of the NSE Nifty 50, or let's say Nifty mid cap and the Nifty small cap, all will give you plus minus 1 percentage point. All returns will be similar. What has happened in the last 5 years is that Nifty 50 or large cap has given you 100% something return, and mid and small caps have given you 200% something wrong. So for the next 5 years, this number should actually even out. I think that conditions and the way things have shaped up for the entire mid and small cap space, the valuation concerns on the mid and small cap space is actually already played out, or we are already playing it out maximum, because the growth rates for the mid and small cap space is far better than your large cap space. Large cap earnings growth is more like 10-12%, nothing more than that. But the mid and small cap space earnings growth can be 25-30%. You have to buy only 30 names. And valuations have now already 20, 25, 60, 70% of the market have fallen 67, 20, 30%. Maybe at best you take another 10% downside. And even then, the valuation metrics of median and mean, they will come below 5 years average. So I am very emphatic about the fact that ignore the noise and buy into specific names. You should be very well off in the next 5 years from today. It's not a case of a sell. Not at all.
Sure. We have a question from Mr. Ganesh Iyer. He wants to know, what do you see the biggest opportunity and the biggest risk for Indian equities at this point?
Biggest opportunities, I think, is the usage of tech in all the businesses. कोई भी बिजनेस में जहां आप टेक्नोलॉजी यूज कर रहे हो ना, वो ब्रिक एंड मॉर्टर सेम बिजनेस, ब्रिक एंड मॉर्टर प्लेटफॉर्म, ब्रिक एंड मॉर्टर फॉर्म में, that company, those businesses will grow far in excess than what the brick and mortar business is. So the whole thing is to apply technology to many of the businesses that are there in India. And in India, there are 52 sectors. 52 sectors. And previous, last 10 years, we were having 10, 12, 25 sectors. Today, we have 52 sectors. Government is opening up new sectors like electronics, semiconductor. These can be very big sectors. But the thing is that you have to see the growth very, very clearly in each of these names. You can't be buying into a 10% growth or zero negative companies where trading at some infinite valuation. So I think the usage of technology in individual businesses is going to create the massive differentiation. ये तो पक्का है. And I think on the flip side, what is the biggest risk is obviously your forex reserves and your deficit numbers. If this AI thing really blows up and Indian IT gets disrupted, and with the merchandise deficit, etc., which we are having, can we actually risk a balance of payment? I mean, it's nowhere near on the horizon, but it can happen if traditional IT gets disrupted in a very big way and AI takes over, then we can be in some sort of a trouble. Apart from the fact that this demographic dividend which we talk about, I mean, if there is not too much of employability, then this demographic dividend can become a demographic time bomb. भाई 140 करोड़ जनता में 25% को तो जॉब्स करना, 50% को तो काम करना ही पड़ेगा ना. So, education reforms, employability, that's the major risk from the next 10 years point of view. It's a problem of plenty. What we are today anticipating as a demographic dividend can become a demographic time bomb. The AI whole story globally, which is becoming a very big successful story, China and the US, might become India's problem because we are the outsourcing hub of IT to the world.
We have a question from Mr. Nishant Gajal. He wants to know, what do you advise investor should do in the current market, lump sum or through STP mode?
Depending on your risk appetite, I think that you should basically buy lump sum, but keep a horizon of 3 years. But you can weigh your risk appetite and even deploy in 3 tranches or 2 tranches if you so feel.
We have a question which wants to know, request your views on REITs, please.
REITs are going to become very, very popular because SEBI has now classified them as equity. And I think they are absolutely low risk instruments. So if your index is giving you 12%, your REITs over a period of time will give you 12%. So you will get a regular dividend coupon plus the real estate appreciation. And real estate in India, provided you pick up the right REITs, will do very well. And they're very low risk instruments. So both selectively find those guys which are already listed, these Mindtrees of the world and Brookfields of the world, they are very well discovered. And today these companies might be trading at a premium to what the NAV is. I mean, there you can't make too much of money. आपको देखना पड़ेगा what is the underlying value vis-a-vis what is the underlying growth. And then take a call on the REIT, but REITs are going to be much more appreciated and liked and bought into going into the future.
Sure. We have a question from Mr. Anurag Mittal. He says, MFs are almost giving the returns as what we could see in this fund. Why could be the reason one should invest in PMS and or AIF?
This debate is perennial. I think over a period of time, this is active versus passive. We don't have the advantage of regular flows. Mutual funds have the advantage of regular flows, and flows determine returns because, the 30,000 crores which is going into the mutual funds and they buying the same set of stocks because you can only buy in a large cap fund the bulk of the corpus in the top 100 stocks only. 80% of the fund needs to buy the top 100 only, or 67% of the fund needs to buy in the mid cap fund only 150 stocks. So the flows come, you buy your stocks, and again you show the returns, and then you buy the same stock. Here we are not having that advantage. Here the flows are far and few in between. So here it is actually more a case of tol mol ke bol than the mutual fund. But if you say that, yes, there is a disadvantage in the PMS and AIF in terms of taxation, yes, it is there. And now SIF has also come. But at the end of the day, over the long period of time, I think power of focus or lesser number of stock always weighs more in an environment when actually flows dry up, or when there's negative flows. You'll see that the alternates will start to perform much better than the mutual funds per se. So yes, there's nothing to differentiate, or maybe it is to do with specific stocks here and there. But I think one important parameter is the continuous flows that go into the mutual funds.
We have a question from Mr. Shailesh. He wants to know view on alcohol stocks.
Very good. This country has only started drinking. The women have only started drinking. Premiumization. Good is going to get better. You are upgrading your lifestyle. It's a play on direct per capita income. Today, alcohol is no longer considered a taboo. Is the generational shift that you are seeing. These are basically brand plays which are not very easy to replicate. And as you step up the ladder in terms of your per capita income, and it gets more entrenched in your daily life, you're going to make a lot of money. Only thing is regulatory. The government tends to take a lot of money away in terms of taxes. So it's not that the maximum value is captured by the manufacturers. The maximum value in this industry is captured by the government. So price hikes and distribution are the two important things that are required, apart from brand image and brand building. So I think individual companies will matter. And once you are done with all these things, of course, the valuations.
We have a question from Mr. Gaurav Kodwal. He says, I'm not able to figure it out. He says that can the commission on PMS or AIF may also be corrected in near term? Okay. Maybe what mutual fund has done.
Today the rack rates are no longer in vogue only. Rack rates are only for visible. These are like there's nothing. So 1.7 if it is the TR of mutual fund. I think average TRs of PMS and AIs are also similar. There's nothing which is, you can say that the government, the regulator can make it mandatory. Yes, they can. But even today, the upside threshold, the actual fees are much lower than the upside maximum that you can charge.
We have a question from Mr. Rajat Shinde. He wants to know which sector do you believe are likely to lead the market over next 3 to 5 years, considering structural changes?
Consumption, capital markets, these are some of the areas. And any company which has leveraging technology. So all the businesses which have a tech attached to it, you must evaluate that the next 5 years these businesses are going to be around. There is going to be a far bigger and the valuations of those. There's going to be a far bigger non-linearity in all the businesses that adopt technology. And there are plenty of them. And apart from that, intermediation businesses and within that capital market will do extremely well.
Anurag wants to know what is your view on SIF product?
Anybody's call, the jury is still out. They will somewhat give more competition to the PMS AI space for sure, because some people will actually launch this 10 lakh product only as a long only, and that will directly compete with the PMS because they are going to have the tax advantage on buying and selling. But nothing is proved as of now. You have a few mutual fund houses which have launched an SIF. Let's see.
Manish, it's a stock specific question. It's your call to answer or not. Mr. Jayesh asked, what's your thought on Indian hotels or Lemon Tree?
Hotels as a space should do well, though valuations is something which you should always keep a tab on. I'm bullish about the hotel industry and the hospital business from the next 3 to 5 year point of view.
I think we have answered all the questions. So thank you so much, Manish, for those insightful perspectives.
My pleasure. Thank you all. Thanks for sparing your time. Do have a look at this product. I think if you were to give me a 3 to 5 year window in terms of time frame, you should do quite well in terms of the actual returns and the alpha from this product. Thanks.
Thank you, participants, for taking the time to join us. And your continued trust and engagement means a lot at Emkay Investment Managers. We hope today's session help you gain clarity on the structural theme shaping the markets and how our new AI strategy is positioned to capture them. Thank you so much.
Thank you, folks. Thank you. Have a great day.